Welcome to my channel, Fiscal Voyage, and today we're going to talk about Main Street Corp. This was suggested by this guy. I'm not sure how to say his name there, but thank you for leaving a comment and watching a previous video. He wanted to see stock analysis on Main Street, so here we are. So we're going to determine if Main Street Corp is a buy, hold, or sell in a 5-minute stock analysis coming right now. All right, here's another 5-minute stock analysis on Main Street Capital Corp. The company is a business development company, or BDC, that provides long-term debt and equity capital to lower middle market companies and debt capital to middle market companies. Main Street defines lower middle market companies as generally having annual revenues between 10 million to 150 million. The company investments typically support management buyouts, capitalizations, growth finance, refinancing, and acquisitions. All right, so let's see how they've done the past 10 years. Revenue grew at a compound rate of 33.40%, which is outstanding. Net income grew at a slightly higher rate at 34.07%. It's that same time period, and they currently have a credit rating of triple B, which is investment grade. In this time period, earnings grew at a great rate of 12.24%. However, the past 5-year earnings average has been at 4.26% and is projected to be less. We'll talk about that later on. Revenue in the past 5-year average has been 13.37% compounded annually, as well as net income came in at 11.67%. Let's look at the fundamentals. Last year, adjusted earnings came at $2.60. Net margin at 78.48%, so they keep a lot of profit. That's great net margin ratio there. It did expand from last year, which was 2017, at 72.50%. Debt to cap currently at 33%, and they currently have a dividend yield of 5.87. However, the 5-year dividend yield average is 6.5, so the current yield is much lower than the 5-year average, which is not something I like to see. Dividend payout ratio is very high at 98.9%. This is typical for companies like Main Street. However, I personally don't like it, seeing the payout ratio so high like that. They have, however, been growing dividends at 9 years consecutively, with a 5-year dividend growth rate of 4.3. However, their most recent dividend increase came in at 2.5% on May this year. They have a charter rule of 10, which is lower than 12 that I like to see. So let's look at the future outlook. 2019, they're expected to earn $2.53, in 2020, $2.56, which is both lower than 2008 of $2.60. However, the company has a current PE of 16.4, which is matches the forward PE. The thing is, the 5-year PE average is at 13.9. So this right here tells me that there's something could be overvalued with this company, the price at the current levels. We'll see how overvalued is it. Over here we have the fast graphs. The monthly closing price is the black line. The blue line is normal PE, and the orange is the earnings of PE of 15. As you can see here, the black line is higher than both, so this kind of represents that the company is a little overvalued. We'll determine now exactly how much overvalued. CFRA doesn't have a fair price, neither does Morningstar. However, Simply Wally came in at $34.27. The fast graph from the previous slide came in at $37.87. Yahoo at 42, and my dividend discount analysis at $28.37. Averaging out to 4, we get a fair value price of $35.65. Currently, the company goes for in the stock exchange at $42.07 a share. So this means the company is overvalued by 15.26%. So with that, my recommendation is a sell. I've had this company on my watch list. It's always been overvalued since I've been aware of it. However, I do like the dividend yield, but it is much lower than the 5-year average. So I always like to have companies that are dividend yield 5-year average is higher at current levels than the 5-year average. However, the company also has a payout ratio of 98.9%, which is very high. And with that, I don't see dividend growth coming in. It may be non-existent or very small, even maybe even smaller than the most recent increase. And if there's a recession, I very much see a dividend reduction in an event of a severe recession. So I'm not buying. I find this company to be risky for my taste. So with that, that's why I have a sell recommendation. So let me know what you guys think in the comments. And if you have a company that you would like to see next, let me know as well in the comments. Thank you for watching, and if you find this video informative, please hit the like button and subscribe to my channel. Smash the like button, please, as well as the subscribe button. Also, you can check out my portfolio link in the description down below, and don't forget to take a look at my website, fiscalvoyage.com. Have a great day, guys. Have a good one.